This week, we've got leading economic indicators weakening, good news for real estate buyers, and more confusing data from the labor market. Welcome back to us trying to figure out what this past week meant for the U.S. economy. We're talking about July 21st to July 25th. My name is Jay Rios, and today we're going to start with a pretty broad question, and that is, what direction is the U.S. economy going? On Monday, we got the U.S. leading economic indicators from the Conference Board, which is meant to give us a look into 7 months out. So it's not necessarily a short term, but it is important to keep track of the business cycle. The Conference Board takes a bunch of data points like the average weekly initial jobless claims, which we'll talk about in a bit, building permits, which we talked about last week, consumer expectations, and the interest rate spread from the Fed. They take all this information and compile it into one main data point, which actually declined by 0.3% in June after no change in May. This has dropped by 2.8% in just the first half of 2025, and that deceleration has more than doubled since the second half of 2024. Again, this is an early indicator into pivotal moments of the business cycle. So as far as the economy goes, no one's really sounding the alarms at 0.3%, but there will likely be slower growth. Why did I originally say there were good signs for real estate buyers? Wednesday, we saw existing home sales, and Tuesday, we saw new home sales. So two different submarkets that we track here. Existing home sales fell by 2.7%, and this was mostly seen in the Northeast, Midwest, and the South, while somehow the West had a modest rise. And really, this has been on a decline since February when housing prices hit a peak. There was a small blip in the early spring season of May. New home sales, though, showed a little more promise with 625,000. Now, this is less than the 650,000 that most people were expecting, but it's still a 0.6% increase. Keep in mind, these data points are taken when properties go under contract, not when they close. And as we all know, properties can easily fall out of contract with inspections, financing, appraisals, etc. So they are highly likely for revisions if buyers don't follow through. As far as regional new home sales, the Midwest and the South had a small increase, but it was really the Northeast that had the biggest amount of pain with a 27.6% decrease. Does slower home sales increase housing supply? Of course it does. Last month, the supply of homes actively for sale jumped by 23.1% year over year, and this is the highest we've seen since 2021, before interest rate incentives were implemented. That puts inventory at 4.84 months, or in other words, it would take buyers 4.84 months to close out all inventory if no more came to market. Despite increased inventory, buyers are still staying strong, with 309,000 properties going under contract in June, making it a 7.3% increase year over year. But buyers are more particular about what they buy. For example, the median days on market ticked up to 42 days from 39 days the month before. And while housing prices are still pretty high, 32% of sellers are cutting their price and more are accepting offers under that original listing price. A lot of this might sound like bad news, but on the contrary, because housing really needs to come back to an equilibrium, even if that means people have to sell for a little bit less than what they were hoping for. Do we have hope for the future, and are people starting the process of home buying? The data on mortgage applications we got right before the most recent one showed that they plunged by 10%. However, last week it did rise by a 0.8%, so not really making up that difference there. And what's with this volatility? Well, it might be tied to the 30-year conventional mortgage interest rate, which is really the most common among buyers. This increased for the second week in a row, but has been slowly decreasing over the past couple of months. So will there be any incentives for the 30-year mortgage interest rate to combat this higher inventory and longer days on market? Not really, because the Federal Reserve wants to see more pain before they start spurring things up with interest rate cuts. As of this recording, the 30-year conventional mortgage is at 6.74%, and the 10-year T note is at 4.4%. It's great to see the conventional dropping, as it was 6.89 the week before, but it really needs to get closer to that 6% to make much of a difference, which it likely won't until later in this year, unless we see some significant economic changes like GDP continuing to decelerate, slowing US retail sales, unemployment rising, and core PCE dropping below 2%. Even if the Federal Reserve does drop interest rates at the end of this month, the 30-year mortgage is more closely tied to the 10-year T note than it is what the prime rate is. So don't expect as much of a change. Here's what Logan Motoshami from Housing Wire had to say about it.
If that comes, I don't believe we have to be afraid of inventory just collapsing or just heading back down to the lows that we saw in late 2020, 2021, or 2022. We will see a pickup in demand, but the buyer-seller profile should look a lot different with mortgage rates at 5 to 7% than mortgage rates from 3 to 4%, because home sales are still significantly depressed.
We've already mentioned a resilient labor market, but with some confusion. So are there weaknesses here? Seasonally adjusted week over week initial jobless claims was a good sign. It dropped by 5,000 to 227,000. And the 4-week moving average is also down by about 6,000. And unemployment is still at an impressively low level. But if we take seasonally adjustments out of the equation, we see a different picture. Non-seasonally adjusted actually rose by about 10,000. Insured continuous unemployment claims are also showing some weakness as those increased week over week and year over year. So from the surface, it does look good, but if we zoom in a little bit, we see that the labor market is softening and people are staying unemployed. Mind you, jobless claims will always be a lagging indicator, so if this goes off, we're probably already in it. Thank you all so much for watching. Hope you learned something. If you enjoyed this content, like and subscribe.